And we're
What's up, bro?
here.
Can you hear me?
I can hear you. Can't see you.
Can't see me, huh? Maybe that's a good
But
thing.
I was, I was trying to do
Or
something.
maybe on your end why you can't see me.
Let's see. Oh, there we go. There we go. Oh man, technology is always fun, isn't it? There we go.
Yep. There we go.
We did it.
We're live.
We are live, my friend. How are you?
We're figuring out this tech thing. Weekend wasn't bad. Just kind of low key.
Yeah, I mean the weather was amazing. Definitely amazing. So yeah, I do like that. But yeah, definitely low key. Saw some family. Dealt with some things, and kept it moving on to a new week.
Yep.
I think we have somebody. Let me see. Let me just reach out. I think we have one more person joining us.
Yeah, I saw that in your outline that I'm supposed to stay on task this week here.
Yeah, we're waiting for that. We'll see if that person comes. But yeah, I mean, obviously, welcome to one and all. This is the Epic Spotlight. Well, no, Epic Lunch and Learn. Excuse me, Epic Lunch and Learn.
You got so many shows going on Hollywood, you can't even keep them straight.
Oh my goodness, I will get situated and get organized. I'm trying to it's funny. Just the overall concept, and I know people probably will respect this and understand this. Like you're trying to build something, and so it's like when you're building something, you need screws, you need hammers, and you're just grabbing right now. There's not really a set blueprint per se, but you're just trying to grab all the pieces, put them together, and make something happen. So yes, this is the Epic Lunch and Learn, 12 p.m. to 1 p.m. Central Time. Here we are talking about current events, obviously real estate and mortgages, explaining products, and having a little fun with it. So appreciate Vince to be with me today.
Thanks for having me back, man. Appreciate it. We're going to tell the audience what the plan is this week a little bit.
We're going to try to do it, man. This week we're going to go 4 times. We're going to try to make it happen 4 times this week. It looks like today is just going to be you and me. And then Tuesday, we're gonna be right back here tomorrow.
Yeah, I'm gonna take tomorrow off. Just let the audience know there'll be a new guest.
There'll be a new guest, so we will work on that new guest. And then Wednesday, I won't be here, but you're gonna run the show. Is that what I'm hearing?
Show?
You said I said I won't. I can't make it on Wednesday. You said you're gonna run the show.
I don't know about that one there, buddy. We'll have to talk about that off camera. We may be doing a Wednesday mulligan. We may be going Monday, Tuesday, Thursday.
I will be back better than ever. Definitely on Thursday. I already scheduled something. This is something we want to bring on a daily basis. Some words and wisdom. Obviously, there's transactions that occur almost every day. And so there's questions that are asked. And I just thought overall, as you and I were talking, one time a week is just not enough. There's just so many questions that people have as far as their mortgage. What do I do? Is this a good time to refinance? Is this a good time to buy? Hey, this loan officer's offering me this. What do you think? I just thought if we put this on a platform that we talk about it every day, we're going to get to some people that needed, just the Q&A. They just needed to have a thoughtfulness to it. And I know we could definitely bring it with the years of experience that we have.
Absolutely. I mean, that's what we talked about too. And, the other thing too, we haven't really reached out yet. We do the questioning. We want to take questions. But to your realtors, you can invite your clients, your potential buyers to this.
Definitely.
We want to build trust with them. Dante and us want to earn their business as well as your business and work together on it. It's kind of why we did this. Part of this is creating this trust earlier in the process, which makes the sales process easier for everyone involved.
No, I agree with you. Can't agree with you enough. I mean, it's kind of like, who is this for? Like, what is this all about? Like I said, there's just so much questions that go into, is this a good time to buy? Is this a good time to refinance? What do you think about this? This lender said this. There's just so much noise, and you just don't know who to go to. And I figured if we got 2 guys that have 20 plus years of experience, jump on this, for an hour, that we could talk about it, rationalize it, and just give you the pros and cons. because to some degree, there is no real right or wrong per se. There is a lot of gray matter that happens just in the mortgage space, real estate space. And if we have a forum that we can talk about it, share some ideas, it might help you individually. And it may also help someone that that's going through it, a friend or family, and just give them another alternative. Especially too, for those that might be going to a loan officer that only works for a bank. He only has that certain, rules and guidelines. He may not have all the product lines that we have, and vice versa. So, we want to share what we know and just products that are available to you, and see if that can definitely help out.
Yep. That bank only has that certain box to work with in that toolbox.
Yeah, I don't want this to be I don't want to rain the parade.
No, we're not bashing on anybody, right? But I mean, it's some of the different things we talked about this week. We're going to talk about the basic loan programs, and then I know you also said you wanted to talk about the non-QM products and how some HELOCs work into those things. So,
yeah.
It's exactly what it is, right? It's a different way. It's a different approach. And it's just making people more comfortable with asking the questions they want to ask at the format they want to ask them.
100%. I definitely feel like, as we've, just spent so much time in this industry and just kind of got used to, just the product line, I just feel like there's a science to it. I just think that it is really systematic. Like, oh, if you're going to do this, here's your options. And there's, once again, there is no right or wrong. But once you know what your options are, if you go down this path, there's just too many people, especially from a migration situation with so many people, coming from outside of this country, didn't grow up in necessarily the school system that you and I did. And even the people that have gone through the school system, this is not taught in schools. So a lot of this is kind of new. And I see a lot of people pick this up during just word of mouth, talking to a friend or talking to, because the good or bad, and maybe this is our trailblazing setup. 48%. This is based on an NAR report, National Association of Realtors. 48% of consumers, choose their loan officer by their realtor. And that's almost 50% of consumers. So they didn't know who a loan officer was. They didn't know how to go to us. The realtor said, "Here, go here," and you just did. It's kind of a blind faith, but it's also just a necessary evil, right? We're not the sexy part of the transaction, and it's like, oh,
Nope.
okay. And then they assume that we're all the same. It doesn't matter if it's Dante, Ted, Paul, Chuck. We're all the same, and we're not. We're not the same because we work for different entities. We have different products. We have different knowledge base, different experience based on how many deals we actually do close. All those things matter, and there's not as much of a grilling resume section to the process. Most people will tend to just go directly with whoever's got the lowest rate, but they don't have the experience. They can't get you to the end of the road. And
Correct.
so, that's where we hope today will give you some, at least a little shed of light, and we can always extend this out. We can start today and make this, a part 4 series, of just all the different product lines, just in case we don't get to all of them.
Yeah, absolutely. I mean, that's always something we can always drag into the next episode or carry on to another time when we talk about credit scores and different things. But to build to your point, with the NAR changes, with the buyer's agreements now, with agents on the purchase side, on the mortgage side, you want to get your loan officers involved earlier in the financing to help you realize how to truly structure that transaction, or whether they're going to use a gift or go FHA or go conventional. So
I still know there's realtors out there, and I'm not going to name any names, but I still know they'll show houses even if a person's not pre-approved for a mortgage.
Yeah, and I mean, I don't necessarily mind that, because at the end of the day, the consumer wants to choose who they want to work with. So going out to coffee, showing one house, and then having to do the sales side of the real estate job and say, well, hey, if you want me to go again, you got to get pre-approved, or you got to show me who you're pre-approved with. I don't think that's a bad thing. I mean, in the world today, right, everyone does internet stuff. You shorten the time frame, but real estate's still face-to-face sales. It's still communication. It's still building that trust. And if you put that cap of, well, I don't want to see you until you have your pre-approval, I get it, because some people aren't going to be able to be pre-approved. But I also see the side of that as to, you're taking away from the excitement or the step of building that rapport.
Sure.
Especially if they're coming to you first.
I don't know when it started, right? I don't know when it actually began where the consumer went to the realtor first. I mean, in theory, they should go to a loan officer first, get pre-approved, know exactly what their payments are going to be for a certain type of house, then go choose a realtor. But somewhere along the way, they, got steered to go to the realtor. Let's look at the home, to your point, get excited. Oh man, I love this house. This is going to be amazing. Envision a life there. And then come to find out they may not qualify for it. And that's the only scary part of, looking at a house before you actually know, can you qualify for that house?
Yeah, but you got to remember
that
the consumer in today's world remembers they don't want to hear the word no.
Of course.
Right? They don't want to hear no, you're not qualified, or no, you can't do it at this time. And you brought up the excitement of being able to look, right? And the point of the pre-approval and we've done this for a while, we can give pre-approvals out all day long, right? We can have a conversation with people, pre-approval, but until you find the specific house, you're just playing around with numbers. Like at the end of the day, until we have an offer approved or a contract approved, there's nothing we can really work on.
True.
Right? Because we've already done all the pre-steps. We know the ranges. We know everything of what it's going to look like. We know where we stand. The only thing to add to that is when we get involved earlier is if we need a down payment assistance or if you need a gift, we could start working on that process a little earlier. But we're not involved in the 6 months that it takes to truly find a house and work with that client from the realtor side from start to finish. We're involved in the last 45 days.
Yeah. The final
besides occasional conversations with the client or doing it a pre-approval 2 or 3 months ago. Because remember, credit's good for 90 to 120 days, depending on the lender.
Got it. Yeah, let's get into it. Actually, we and once again, Vince, you said
some questions here.
Getting some questions.
It's all right.
And this is great. This is for you. This is for you out there. If you have a friend, family, neighbor, or yourself are looking into buying a house, whether it's primary or investment, this is for you. We're gonna be here to answer questions. So let's go off with this first one. Which loan type is best for a first-time home buyer with low savings?
To me, that's FHA. Well, let me before quick answer is FHA. But let me put a cap to that. If your credit score is above 720, you're a conventional loan. Anything under the 720, FHA, first time home buyer, lowest possible down payment other than VA and USDA. To me, that's it because this is your first home. It's not your last home. Keep your cash, keep the reserves. It allows you to have higher expense factors and for qualifying, and I'll stop talking so you can add to that.
Yeah, I would. I agree with you. The quick answer is FHA. It's the Federal Housing Administration. It offers a minimum down payment of 3.5%. So 3.5%. Let's just keep it small numbers. If you got a $300,000 property, which is pretty kind of normal in this marketplace, you're looking at roughly $10,500 that you would need to be able to put down. So low savings is one of those subjective terms nowadays where I don't know exactly how much you have. But you also do have closing costs, so don't forget about closing costs that you will have, because that's added on. So there's actually an equation. I wrote it in the book, The Ultimate Mortgage Guide. You can get on Amazon. There's my shameless plug, but
that's a plug. He hasn't plugged that one since we started, ladies and gentlemen.
We're gonna have to plug that and let people know. But yes, I wrote a book about this. And a lot of people say, why did you write the book? Why did you write the book? It's pretty cool that you wrote this book. And I was like, to be honest with you, I got in the business in 2002. June 24th, 2002 was my first day in the business. And it's kind of eerie to some degree. Eerie, I'm going to use that word, that the same questions I was getting back in maybe July of 2002, I still get today.
Yeah.
And so, the thing is, it's just, once again, it's not taught in schools. And so these people that have questions over, 20 years ago are still asking the same question, new people with the same question. So I wanted to get a baseline for everyone. I said, here, if you read this book, you know the equation it is to buy a house. If you read this book, you have an idea of just some products that are available for you under these umbrellas. But FHA is great. I kind of lean on FHA 700 or less, or 699 or less. At the 700 mark, you'll see the PMI break on a conventional loan. I believe at 700 is cheaper than a FHA PMI.
I agree with you. The only thing I take to my credit score is the LPAs, taking into effect the difference to the rate thing. I wasn't even looking at it from a mortgage insurance standpoint, right? Because the mortgage insurance on FHA is standard for everybody. It's 55 basis points. It's not dictated on your credit score. The one other thing, he didn't mention it, and I didn't first mention it. Remember, too, for first-time home buyers, low savings, make sure we ask for concessions in terms of closing costs more than reductions in the housing price.
100%.
Right? And there's other ways to structure those concessions, and especially because we work in majority of our loans are within Illinois. Taxes are paid a year behind. So that gives someone almost 8 or 9 months worth of tax credits. And that money can also be used to offset other costs. Let me be very clear. Concessions and tax credits cannot be used for the minimum investment. The minimum investment on FHA is 3.5%. It doesn't mean they need the 3.5% in the transaction. They need the 3.5% available.
Well, you can deduct. So you're talking about MRI on FHA, 3.5%. You can deduct obviously earnest money. So the earnest money that you put down can be deducted off the 3.5, and tax preparations can be included.
That's correct.
So tax preparations, which is a benefit in Illinois or states that have higher taxes. So Texas, I'm thinking of the states that we're licensed in. It benefits in Texas, Illinois, and in Maryland a little bit. So you definitely. So what he's talking about on FHA, regardless of, hey, great news, the seller is going to give me, up to 6% seller concessions. So the seller can give $6,000 or, on $100,000, just for simple math, the seller can actually give $6,000 of a seller credit to you. And in those terms, let's say it just helped you reduce the payment, the cash to close to $2,000. Well, that doesn't matter if you haven't hit the MRI. Your MRI is still the 3.5% minus security deposit. Earnest money is virtually the same thing for people that are renters, and the tax preparations that you receive. Tax preparations are, basically a credit that you receive from real estate. Most states have taxes in arrears. You're paying state tax. Real estate taxes from last year. So, second installment of taxes. Obviously, we're in Illinois, so we're going to see real estate
year, whether it's February or whether it's September or March and so forth. I know we're also licensed in Michigan. They do taxes a little different.
Yes, they do.
They have a summer and winter installment.
Yes.
I know we license here in Florida as well, and they do it once a year, I believe.
Correct. Yeah. So it's one of those situations. So it's state specific. But the overarching, now we have some new programs, and I'll just use this as a timeline for those of you. We had a closing last week. So shout out to the Wood family. Appreciate your trust and belief in us, and I'm glad we were able to help them. First time home buyer. She was a nurse and she was buying her first home. We actually were able to provide her. She had a 720 score, and so we were able to get her a 5% down conventional loan. But with one of our special programs, we were able to give her a 2% grant. And that was super cool. So we have access to grant money on the conventional side. So we don't always have to go FHA to get some free money. We can go conventional. We got a 2% grant. Some are eligible for a 3% down, and then they can get a 2% grant where you're only having to put 1% down. Those are a little bit harder to get. So I don't like advertising that because I don't want to say I can do it and I can't. But more realistic is you will be putting 5% down and I can get you a 2% grant if you fit the income thresholds of a specific county that you're looking to buy in. So we have that. Yeah, go ahead.
I'm sorry. I was going to ask, is it based off of AMI for a certain location?
Yes, it is. Yeah, AMI. You want to explain AMI real quick?
Average medium income. It's, basically what the surrounding of the area is typically on these programs. And I haven't done grant loans in a little bit of a while, but typically it's 80% to 100% of the AMI.
Yep, 100%. And so in the Chicagoland area, in this particular one, it was about 94,000 for an individual person. So if you make less than 94,000, and you got the 720 credit score, we can get you 5% down and get you a 2% grant. So you're only putting 3% down. And that was a huge situation for, example for this question where it was like, hey, look, I only have, she was like, Dante, I only got $13,000. We got to make that money work. And so the grant obviously got us in that situation, and we just got it there to make it happen for us. So shout out to the Wood family on that. We got some more questions, though. This is great. And please keep them coming.
I'm glancing here. I'm trying to watch multiple screens, right? Watch you talk, me talk, and the questions. I know we've seen a couple VA questions go by.
Yes.
And I don't want to tackle the VA questions right off the bat.
Okay.
Because I want to spend a little time on the VA program to show why it should be pushed more and other ways to present it in offers on the financing side. But maybe we'll talk a little bit USDA. And there's a question about the easiest way to use a HELOC or the smartest way to use a HELOC. And let's address those, and then we'll go to the VAs because I do want to talk about the VA stuff.
All right, I'm writing it down just in case if more questions. But yeah, please keep them coming today. We are here to answer your questions and give you knowledge. This is live once again on LinkedIn, Facebook, and YouTube. So we're getting a lot of love from YouTube right now. Appreciate that. We want to see some LinkedIn friends and Facebook friends too. If you're out there, if you know a friend or a family or a neighbor that's looking to buy a house and they have questions, now is the time. You got us right here for the next, at least the next 40 minutes. But let's go with what's the smartest way to use the HELOC? You want to do that one?
So to me, we've talked about HELOCs. I mean, obviously, getting a HELOC is better than having a high interest rate credit card. The smartest way to use the HELOC is to pay it down every month or keep the limited balance to it. And let me kind of give an example on that. Let's say you have money sitting in a savings account and it's doing absolutely nothing for you. You take a HELOC and you use that money, and every month you take the money from your savings to pay down your HELOC. You still have access to it. You're just not allowing cash to sit there. It's still serving you a better purpose because you can pay the credit cards down and still have your emergency fund. That's a quick answer, but that's what a HELOC's for. The HELOC's for emergency purposes or consolidation of debt.
Yeah, I agree with you. I always feel like, you have to have a purpose or at least a mindset approach of like, how are you going to pay it off? I think it's important to have a game plan of how are you going to pay that off. I think that's very important to do. I had a call actually this morning, ironically. So I had a call, and it was a lady called me up. She got referred to me from her sister, and she said, "Hey, I'm looking for a HELOC. I'm in a little bit of financial trouble." I said, "Oh, okay, what's going on?" Credit card bills have kind of just accumulated over the year, and also too, her property's free and clear. And so that means she has no mortgage on there. House is worth about $300,000. And she's and the tax bill, came out. So for people, she's based in Aurora. So the Collier counties of Illinois, the taxes are out, and the second installment is due in September. And she's like, I'm kind of backed up on the taxes too, and it's a tough situation. She's a bus driver, and so therefore she works when the school is open.
When school's busy, yeah,
right. So June and July, that's it. She's sitting idle until school starts. And for Illinois, for most, it's going to start, towards the end of August, beginning of September. So I said, "Hey, where do you think your score may be?" And she said, last time I looked, maybe about like a 620. And I said to her right then and there, I was like, first and foremost, you're probably not going to qualify for a HELOC. You
Yep.
know, your score is too low. And since you don't have a first mortgage, why don't we just do a first mortgage? Why don't we just get a cash out refinance on a first? Because, even with the score being 620, I could probably get you in the 6 or 7s versus you taking a line of credit at, 10 to 11% just based on credit score because you'll be the lowest person. Because,
Yeah.
to your point, lines of credit generally are from 8 to 14% right now, depending on how high of LTV and where your credit score lies. So it doesn't really make sense to take something even higher. And I said, what we can do is, with, obviously going in that 620 world, she's probably going to fall into an FHA loan. And I was like, well, with that 620, we're going to, mandate that your tax insurance, we're going to set up an escrow account. So then that way you don't get yourself into trouble, because that's what I see with a lot of people is when they don't have the escrow set up. And
Yeah.
so, they're so used to like these lump sums that come out sometimes with the second installment, they're ill prepared for them.
Yeah, especially in Illinois, right? Because the second half bill is a little higher than the first half bill, or the budgeting or whatever. But
Sure.
in her work situation, she's kind of seasonal to a certain extent,
Correct.
right? So it's a liquidity issue.
100%.
But at that 620 credit score, wouldn't you want to throw her into a conventional under 80 so she didn't have the MI?
If she's 620 and we can, that would be optimal, right? Because you want to avoid the PMI.
And just for the audience, 620 is the entry level to conventional. And as I stated earlier, I would always recommend buying a house using FHA at a score under 700, as we talked about. But with an LTV under 80, it kind of changes that parameter a little bit.
No, good point. So it would be something that, obviously I would have to run her both ways, see what's the better deal. But obviously, if I can get her approved on a conventional refinance, it makes more than enough sense to just get it done that way.
Yeah. And I mean, I'm assuming you're going to be, unfortunately, we're capped to $100,000 loan amounts as a minimum to that type
Correct.
of transaction. So just kind of giving the audience a little bit added to those, the behind the scenes.
Yeah. And obviously, to your point on planning, we want to plan out that she has enough money, not only just to cover whatever back taxes she may owe, not what she may owe this year, but we want to give her some money for next year. So she's already got, a cushion, like, hey, the money's already secured, and obviously it'll be based on her debt to income ratio, how much income she makes. But, it is that understanding that, hey, we want to make sure that you're covered along the way. So, it's one of those things where we do the planning and we're looking at all of the products. Today's conversation was about products, so we've talked about conventional, we've talked about FHA, we've talked about the HELOC. So let's go into the USDA. I think I saw a question here.
Yeah, absolutely. So here's what I'd like to do with the USDA. I'm going to give a couple of my points because I don't do too many of them. I think you have a little more history on that, and then you kind of add to that.
Sure.
So the USDA loan's great from the standpoint it allows you to finance 100% just like a VA loan. It has credit score restrictions just like FHA does. It doesn't have mortgage insurance, if I remember correctly. It does
have MI.
Okay, it does have MI, so more like FHA than VA. Correct. What does that mortgage insurance payment look like? As with FHA, it's 55 basis points for every $100,000 you borrow. Does it vary on a VA on a USDA?
Oh, good question. No, it's a flat one. I think it's like 0.34.
Okay. Do they count utilities as part of your expense factors?
Those are all good questions. I had to figure it. It's been a while. We don't do a lot.
The reason I asked that is because they do count electric and utilities within the square footage of VA, right? So I was just trying to do some little small things that we don't really talk about as a behind the scenes of things that we talk about in ratios, right? Because at the end, ratios matter. Like VA is very lenient on the ratios, but they have something called residual income, which we'll talk about in the VA point as to what that means.
Yeah, I mean, obviously, USDA is based on rural areas, and they have a map to see if, the area will qualify. For Illinois based, I mean, you're thinking like Yorkville, that type of area. Obviously, in some of the other states, is more common practice. Like, Georgia, we see a lot of USDA. Florida, we see a lot of USDA. So, it's just another avenue to look down, based upon, just the concept of no money down. As far as no down payment, you still have closing costs. Never forget about that. And that's important. And to her question, Lori, says, are there any zero down payment besides VA and USDA? And the answer is yes. That would be FHA. FHA has now provided a down payment assistance program, and so that down payment assistance program basically covers the 3.5%. Okay, and you have an option. We like to call it option B or option C. Option A, obviously, if you have the money, just buy the house with FHA. But option B is we give you the 3.5%, and you have to pay it back. Within if you sell or refinance the property within 5 years, you have to pay the money back. Option C, we have an awesome program that basically you do not have to pay the money back as long as you make 12 months of payments on time. It's a little bit of a higher rate, but then there's no strings attached after the year's up. Year meaning you can go anywhere and work with anyone to do the refinance. I can do 6 months if you just stick with me. So, repeat business is one of the things that we focus on and pride ourselves on. And you can just work with me, and then we can cut that year into 6 months after you make 6 months of payments. So FHA is definitely a third option in the zero down options besides VA and USDA.
See what else we got here. I don't really have too much to add on the USDA other than off the top of your head. Is there an acreage requirement on the USDA or a limit?
Yeah, there is a limit. I don't have that information. If you email me at dante@epic.mortgage, I can get that information and send that over to you. I don't mind looking this stuff up afterwards.
I stumped the teacher, ladies and gentlemen.
You stumped the teacher. Is USDA financing limited only rural areas? Yes. Yeah, you're not going to find a USDA in metropolitan areas. It is going to be in rural-based areas. There is a map online. If you Google USDA financing map, it'll show you areas, and it'll show you the website you can log in as far as provide a zip code to see, what qualifies. But yeah, that's makes us a little dangerous. But yeah, we do have access to USDA. We do see it commonly in the South. We're licensed in Texas, Georgia, and Florida, so we see it more down there than we do necessarily in Chicagoland area.
Okay. I caught a question here at a glance. Helping agents talk about interest rates.
Okay. Oh yeah, I see it. Got it.
So to me, it's all part of the transaction. It's a piece of the puzzle. And it's a piece of the puzzle that you don't see every day, but I understand you're getting that question from the borrower probably before we are, which goes one to the point of why we want to be involved earlier in the process. And the second piece is that use resources. Instead of putting those questions out there and you telling them, have them directed to resources. And the resource that I direct clients to is FreddieMac.com. Now that is based all on conventional, so you have to put that little disclosure there, but it's coming from a place where they can research and get that information. So it's not coming from a sales perspective of you telling a rate and quoting something that could be different in the market. We've had a little bit of a recent drop in rates over the last couple of days because of what happened with the market. They didn't cut rates, but the bond came in, and that's a big deal in that. And the point of the rates, too, also depend as to, can we get concessions to buy a rate down? Can we do a buy down? Are there options to lower a rate in a different direction? So I'm kind of staying away from my agents wanting to discuss about interest rates because that's where I want to be involved in that conversation. Giving a range is one thing, but remember, a credit score of 620 on a conventional deal is going to get a much different interest rate at a 680 or a 720. And that goes with everything.
Yeah, I mean, we're going to get some realtors on here and definitely have that conversation. And I'm curious to hear what they say. I know you want to kind of be the beacon of light for the customer. You know everything, but Yeah, I am a little bit more of stay in your lane. Obviously that's why we have a mortgage license. I mean, we have a mortgage license to speak on interest rates. You can always touch base with us and have a general sense. But I mean, to some degree, that's why you have us, plugged in. That financial team we've always talked about is, it just depends on who you start off with, right? Do you come to the loan officer first, get pre-approved, and then you're working with a realtor, or are you working with a realtor first and then you're going to get pre-approved because now you've seen something that you like? However you start the process, I mean, eventually you still will have to talk interest rates. And the hard thing about rates with realtors is that rates fluctuate every day. So for them to just like say something, you've already set the tone for something that now they've heard them, oh yeah. And it's like, and then I'm the bad guy because the
Yep.
rates changed or the rates fluctuate. I'm like, no, that's incorrect. No, that's not right. And then now I'm recorrecting you. And and that's just not a good situation. So I'd like them to just refer those questions to me.
Not only that that's not a good situation, we're potentially causing your client to mistrust what you said because you said one thing and then we're coming back with something different, and it creates that breakdown potentially. Not saying that, but it gets into that he said this and she said that, which is what we want to avoid.
Correct. I see two questions about that VA. So if you're ready,
Yeah, I'm
let's
definitely ready because I mean the VA to me is a great product. It just needs to be taught more, and as an industry, and I mean I'm gonna throw up some different things on the VA because there's a lot of misconceptions as to it's 100% financing. They don't have the money down to put down. That's the reason why they're doing this VA loan. It's completely not the case. VA appraisals aren't any harder than an FHA appraisal at the end of the day. So we'll get into that and we can get started.
Yeah, I would say, yeah. So VA is a great program. First of all, I appreciate everyone's service. My dad served. My grandfather was a Tuskegee Airman. A fighter pilot. So, I'm a big advocate for the veterans, and I'm here to help. First and foremost, I do believe there is a tier structure when sellers and listing agents are trying to determine who to accept, when you have a multiple bid situation. And generally, the kind of rule of thumb has always been cash first, right? If you have a cash buyer, I'm taking that guy because he should be able to close within 2 weeks.
Right.
Then I'm going to take a conventional buyer with 20% down, right? Because the urban legend, as I'll say, or the myth is that, and there's some truth to it. The conventional appraisal is usually easier to get through. There's not all the nitpicking that you'll see on a government sponsored appraisal. So generally, conventional buyer will be the second person. So we have cash, conventional, and then third, we get into the Govy loans, whether
Yep.
it's VA, FHA, those types of things. And so I think VA takes precedent over FHA because sometimes the mindset is, oh, it's an FHA buyer, they got a low credit score. But that's
Mm-hmm.
not necessarily the case for VA.
Yep.
It's like we see a lot of 760 VAs, the 720, 680s. They don't have bad scores. They're just veterans.
Yeah.
It,
And we can use AI or someone could pull it up. Average VA credit score is 680 or higher.
Love it. Love it. So, I mean, that just, cements the point that I'm talking. And so it's just one of those situations where I feel like, VA is a great product. We do have termite inspections. We have to do a termite inspection on every property, regardless of refinance or purchase. But
Pest
yeah,
and, pest and well inspection, since we also do loans in Florida. So that's going to always come up.
correct. And I love the widows. The widows
Yeah.
get, and I just explained this to a client right now, Miss Edwards. I said, hey, Miss Edwards, you're still eligible. I wasn't the veteran. My husband was. I said, you still get his, his benefits. You can still take advantage of benefits. So widows that had a husband that were, deceased, they can still take advantage of those VA benefits and buy a house. So I think that's a great opportunity as well.
Yeah, there's that too as well. And the other thing too is debt ratios and expenses. So again, I mentioned this in the beginning. Residual income is different on a VA loan, meaning there has to be additional income to cover expenses per person in the household. So it's different in the calculation than our traditional FHA and conventional, but the ratios allow to expand to almost 62 to 63% of the person's income. So it allows for higher expense factors, which are helpful. When we talk about seller concessions, we can pay off consumer accounts with the concessions from the seller. So not just for title fees or closing costs. Let's say they have a car payment that has a $5,000 balance on it, and you ask for concessions from the seller. You can use those concessions to pay off that $5,000 consumer account on a purchase. So there's a lot of flexibility in terms of what you can do. But the biggest thing for me on a VA deal is once you have financing, other than the cash and the conventional, FHA and VA are all in the similar bucket. The difference here is the veteran may be exempt from a funding fee, which is different from an FHA loan, which has the upfront fee. VA funding fees are exempt from veterans who have a VA disability of 70%, I believe. So there is no charge for the veteran to borrow the money as there is when we get charged from the FHA government.
That's good stuff.
So qualifications are what they are. Appraisals are a little bit easier in the VA world because as a loan officer, we can talk to an appraiser. And there is a process called, I believe it's Tidwater, something allows us to challenge a VA appraisal if it comes in at a significant difference. There is an actual review process that it would go through. So that's something that people don't necessarily look for. In terms of structuring a VA deal, the biggest thing is the myth of a VA borrower is not qualified. And it's debunking the myth of, hey, no, these are actual qualified clients. I mean, let's remember, most veterans are receiving some form of VA disability to a certain extent, which is an additional income source to their 9-to-5 job.
Yeah, no, you're right on that. And obviously that helps increase their purchasing power.
Yep. There is no mortgage insurance, so there's more money to that. Some municipalities allow veterans to be exempt from property taxes when their disability is 70% or higher. So imagine that a VA person in Cook County could have a property without paying taxes. Property taxes, not taxes, property taxes. So there is so much more room in that qualification than's out there. But it's the point of agents here, conventional, cash conventional, FHA, and the seller here is VA 100%. Why would I give him the loan? Right? Because at the end of the day, price dictates whose offers wins within certain parameters. But to me, the higher price offer is always going to be taken at the end of the day, unless the agent can convince the seller the reason why they should take the lower price offer.
We actually had a deal in Maryland that we closed last week, end of the month, where the client, based on kind of a curious one, but let's just say it was a mom and a daughter. The mom just didn't make enough money off her VA benefit by herself. Maryland, tends to be, you're looking at $400,000 to $800,000 is just normal purchase prices, and so we had to use the daughter. So you can't go VA when you're using a son or a daughter. You can only go with your spouse. So as a veteran, you can either go by yourself or with your spouse. So in this example, they had to use their daughter. And so when they used their daughter, they, obviously we couldn't go VA, but we went FHA. But the lender still allowed us to take advantage of the tax exemption that the veteran would be receiving, in the county. And so if we can prove that the county does acknowledge, veterans, which, I don't know too many counties that don't,
right.
that are disabled veterans, they are going to be tax exempt. we don't have to count that in their debt to income. So, deal got a little dicey because the value, the homeowner's insurance came a little bit higher than anticipated, some unforeseen things, but we were able to get that deal done because we didn't have to account for those real estate taxes from day one, which is huge. Not every lender does that. We fortunately have 2 lenders, at least that I'm aware of, that, hey, we'll take that into account. And on day one, we will not, escrow real estate taxes whatsoever and not count it towards your DTI.
Yeah, I mean, that's awesome. I mean, on a side note too, though, right? Some lenders follow the rules, and then some lenders make up their own rules, right? Because at the end of the day, that tax exemption is gonna happen,
right?
And it's just, hey, are we gonna give it to me now that we're supposed to, and this is what it is, and it reduces the qualifications, and the person can buy the home, or do we have to wait, right? And the waiting is just shouldn't be there anymore.
Yeah. I think to answer Anita's question, can VA loans still win in a competitive offer situations? I think the answer is yes. Mm-hmm. But I mean, I think it's a skilled set within your agent of explaining and, debunking. I love that word, debunking any myths that people believe. Oh, VA, it's a government loan, probably got low credit. If they can kind of debunk some of that with the listing agent, and let them know it's a veteran that is looking to move in, I think you have a good chance. But I would lean on I would definitely go ahead and lean on the actual listing or buying agent to bring it home. Now, what about this one? How can agents get better at spotting qualified VA buyers? That's a marketing question. You got any ideas on that?
Well, I mean, we want you to take as many VA buyers that you can have. They're awesome, tremendous programs, right? But I mean, at the end of the day, the veteran knows if he's qualified. Some veterans don't like to use their VA benefits. There's a stigma. Well, I don't want to do that. And that stigma comes from what they went through potentially and different things. But the VA buyer is, like I said, average credit score on a VA loan is 680 or higher. So it's always higher than a conventional. It's always higher than an FHA person. But spotting the qualified VA buyers, it's just asking the questions. I remember when I first got into sales, I didn't ask. If you don't ask, you don't know.
Right.
Right? And it's part of your screening process. Are you a veteran? Do you have eligibility to a VA loan? You can have multiple VA loans at a certain time. You have extended eligibility requirements. There's no loan limits on a VA loan either, where a lot of people think that it caps at a conventional loan limit. Doesn't cap at a conventional loan limit. It just requires a down payment when you go above a certain limit.
Yeah. No, I agree. I think the best way to kind of answer that question is usually birds of a feather flock together. Veterans know veterans. They hang out, so if they're all, military moms, I have had a great response right now on an internal situation, and the military moms know each other. So they know each other. They're a really tight community. You'd be surprised, and especially if they have active duty,
or near the bases,
near the base, So if you were looking to attract, I would look at the base. Fort Bragg, Fort Jackson, wherever you're close by. If you really were trying to target them as a potential, you would want to definitely, by all means, start at the fort. Fort Jackson, Fort Sumner, and so on and so on. So I think you can find them there, and that would be a key source for you as far as marketing goes.
Your VFW halls potentially.
Yep. Fish fries on Friday, man.
No, just throwing it out there. I mean, to me, it's a great program. It's a give back to veterans who have provided service for us. It's a no down payment loan. It's essentially a zero cost loan at the end of the day, because you can add the concessions to pay for title fees and commissions and everything else that goes through. As far as getting the seller to accept a VA loan, at the end of the day, it comes down to price. So the veteran can give you 100% of the financing. There is no down required. And it doesn't mean you can't show money that the veteran has. Let's not get away from, a veteran can have $100,000 sitting in a bank account. And if that makes your seller feel better to see those funds, or hey, they can put $5,000 down, they're going to get the $5,000 back anyways.
Right.
Just because it is a VA loan that doesn't require a down payment, it doesn't mean you can't put an earnest money deposit down on the transaction to make your seller accept that offer at a better feeling of they have some skin in the game.
Sure.
So, there's awesome streamline options. And what I mean by streamline options is when rates go down, there's options to refinance the VA loan, just like there are for FHA loans that don't exist for conventional loans.
Yeah.
And this is talking about then reducing the monthly household mortgage payment after the purchase.
You do you have that acronym down, Pat? Can you label it?
ERLA, you mean?
Earl.
Interest rate reduction loan.
Yes, there you go.
There you go. So we try and remember those acronyms, Sometimes we get them right, sometimes we don't. I still remember LTV is loan to value.
There you go.
Right, or
DTI.
DTI is debt to income, but in terms of the loan to value, basically, right, that's your LTV. That's what you can leverage to a property.
And it's pretty cool because you can go 100% on the cash out refinance of a VA as well.
Correct.
So you can go up to 100%. So, so if you need to maximize, and that's really the only opportunity out there that I can think of that allow you to go that high. A veteran, they'll allow the veteran to go up to 100%. But everyone else, we're mandated to 80% unless we're going to go with the HELOC. And even HELOCs kind of cap you at about 90% is roughly how high we can go.
Yeah, and again, right, it's backed by Jenny Mae, who's the servicer for VA loans. Basically, they make up the rules, just like Fannie Freddie make up the rules for conventional, and FHA make up the rules. So the program's backed by the government. It is a government loan, but it's a tremendous loan program when used correctly and structured correctly. Yeah,
exactly. All right. And then appreciate Clive. Appreciate that. We're just trying to help out. We're going to try to do this. It sounds like we're going to do this 3 times this week.
Yeah, let's correct that. There is no Wednesday. Vince is not doing this solo.
So there is no Wednesday. Unfortunately, I already got a engagement that I already committed to, but we'll be here tomorrow. It'll be me and Marissa, and then it will be Vince, myself, and Yolanda Peavy on Thursday. So we'll send the reminders out there, and we'll get it going. And then let's try to answer this last question, and then this actually helps me for tomorrow because it saved all these questions I was going to ask, and it's like, oh, this went a whole different direction today, which is great. What red flags should agents look for in clients' pre-approvals?
Well, that's tough, right? Because
question.
Every loan officer can issue a pre-approval to whatever they really want. And I know that sounds horrible as a statement, but there's no safeguards, right? I can put whatever I want on a pre-approval, whether or not the client gave me the income and verified it. The pre-approval is only as good as the loan officer information that they validated to do that. And again, that goes to the standpoint of starting the process earlier makes potentially the pre-approval stronger. And I'll be the first to admit to this. Sometimes if I have a previous client call me and they say, hey, their credit score is this and their income is this, and I've run their credit before, I'm going to give them a pre-approval. I might not even pull my client's credit because I don't need to, because I know what they have. So the validation of a pre-approval is the stepping stone of getting the offer accepted. It's the pieces that happen after the inspection, and it's the time frame of how long it takes to move that contract to the next step. So when you're worried about how valid is the pre-approval, one, see if they'll give you the money to say like, hey, I'll show you my bank statement that shows I have the 10% for the down payment, as opposed to just writing 10% down on the contract to get your offer accepted. There's steps we can do along the way, but until there's a true contract accepted from the lending side, there's really nothing we can really truly do other than your loan officer you're working with has validated the information. because what goes out in public is just what it is. So
yeah,
I didn't mean to dance around it, but I didn't want to turn around and say the pre-approval is garbage. It's the right to go shopping, but anybody can write whatever they want on it. And what I mean by the garbage side is if 6 days have gone by and the inspection isn't set or the appraisal isn't set and you're 10 days into a contract, that's the warning signs that something's up. And the longer you let things go as an agent or from the lending side after the contract is approved, the more concerns you have. If things aren't flowing correctly, something's wrong.
I appreciate your candor. I really do, because not everyone is going to admit about their pre-approvals. As some people act like, they put a lot of time and effort, and that's not the case. I've heard through the grapevine of pre-approvals where they haven't pulled the credit. I've heard of pre-approvals where they only pulled one score, conscious, because the cost of credit has just, it's just skyrocketed. It's almost 5 times how much it used to be. When I feel like the old man on the porch, where when I started, credit was $20,
right?
And now it's $91 for
a borrower.
Yeah, per borrower for a tri-merge credit report, meaning that Experian, Equifax, and TransUnion are all in play.
Yeah.
I was like literally given that scenario. I was like, if I, try to pre-approve 40 people to buy a house, you're talking about spending over $3,600 in 1 month of just on credit reports.
Yep.
On nothing more than just credit reports. So it is a very expensive thing. And if you're not doing enough volume that can justify that expense, you tend to find ways to cut corners.
Sure.
And you tend to find ways to minimize that cost as best you can by single merge or single credit reports, or not even pulling a credit report until they're under contract. So the pre-approval, the best way to me from an agent, I don't know about a red flag, because, I wouldn't discriminate if it says Epic Mortgage or if it says, ABC Bank per se, but I would just call. But I would also, as an agent, there's a lot of tools now where you can look these people up, and that you can start, how much experience do they have? How much are they closing on a regular basis? And use that as a kind of a platform. It's like, is this someone that I can tell my seller I feel comfortable with? If this guy has closed, 200 deals in the last year, or this person has only closed 2 deals, it might give you a frame of reference to ask certain questions to feel like, is this person competent, capable, and able? Is this, because most times everyone's busy, right? So, if you called me right now, you'd probably be sent to voicemail. And so how quickly do I call back? How quickly do I respond? Because those are things when the heat of the moment, deadlines, timelines, setting the right expectation for your seller are important. And is he going to be there when I need him? Or is he going to disappear? He or she, are they going to disappear in that time? So I think there's other attributes that make more of a difference. But yeah, the pre-approval it's a tough thing. I take pride in it. It's something I still am the guy that pulls all 3 credit credit scores. I still ask for the income documents up front, regardless. I'm still that guy. It's a creature of habit. But, to each his own. But I think my resume and my receipts probably add up to like, oh, this guy's legit. I'll accept this pre-approval.
Don't want to cut you off when I add them.
No.
Let's not forget it, right? Someone pulls up your numbers. You're in the 1% in the state of Illinois as a loan officer, right?
Country, buddy. Country. Come on.
Well, and the state. They go hand in hand, okay? So it don't really matter that way, right? But let me add something a little bit different. I've done loans in California. I've done loans in Colorado, North Carolina. We write loans all throughout the states, all across the 20 years, right? The first piece of the home purchase is getting the contract approved. You can add things to the pre-approval or conditionals to the contract of, well, hey, once the property's approved and the contract's approved, my buyer's lender will give you the following. As long as the consumer is willing to disclose that information, We can give bank statements. We can give the automated loan approval to support that client is qualified. We can show when we sent the loan to the lender. And what I mean by that is the pre-approval is only as good as the timing of how the file flow is moving along as we get closer and closer to that purchase contract date. And if they're not willing to give that information as you move along through the loan process, then you can have concerns about that pre-approval. But if you ask for certain things as a condition of your acceptance of the offer, you're then strengthening that pre-approval and protecting your seller, which is essentially what you're looking to do as an agent. Because if it's a conventional loan, if it's an FHA loan, if it's a VA loan, there's an automated system. It's not Vincent Dante at Epic Mortgage saying this loan's approved. There's someone else behind it.
Sure. No, good stuff today. It's so funny. The hour is up that quickly.
Yeah, I just looked down for a question and I said, oh, it's 1:00. I can stop talking. Thank you.
No, I appreciate everyone out there that, chimed in a question. Really appreciate that. It made it easy. We had an outline of what we were going to go with. And these questions got us all the way to the end. So we're going to be back.
Here's that outline. We'll use it for Thursday.
Yeah, there we go. I was like, man, I have a whole set. But here, what we'll do is, like I said, we're going to try to bring this to you Monday through Thursday, 12 to 1 o'clock. So we'll be back here tomorrow, answering questions that you have. Please tell friends, family, neighbors, coworkers, if they have a little lunch break, if they have any questions, just put it in the chat. We will answer questions. Got a lot of love from YouTube today. Love to see some love from Facebook and LinkedIn as well. I know we're on there as well. So hopefully soon we'll get that. But appreciate you, Vince. And I'll see you on Thursday, Vince. But You'll be back
on Thursday.
Yep. I'll see you on Thursday. I'll see everyone else. We'll see you tomorrow. So have a great day and stay epic.
Everyone have a great rest of the week. Thanks, Dante. See everyone Thursday.
Take care, buddy.
Bye.